Hello everyone, welcome to first episode of this season 2 of Your Money, Your Taxes. I'm Lalit Abichandani, owner of Abic CPA Associates, CPA firm in New York, New York. Our episode today is about investment planning and Paresh Ji will be educating us about this topic. Paresh Shah is the CEO of Paresh Shah Financial Services. He is a CFP and a wealth strategist for past 17 years and he has been helping business and individuals co-create innovative financial strategies. He's a licensed CPE presenter and he educates CPAs as well as regular clients on investments, life, disability, long-term care insurance. He specializes in pension profit sharing and estate planning. Also business succession planning. Paresh graduated as a chemical engineer with honors from prestigious IIT in Kharagpur, India. He is a 2016 honoree of Long Island Business New Leaders Diversity Awards. Paresh Ji resides in town of Hicksville in Long Island with his wife Shamal and their son Shamik is a sophomore in Stony Brook, Long Island. Paresh Ji, welcome.
Thank you, Lalit Ji, and it's very exciting to be here. You know, the completion of 1 year of the show, I think makes us feel good also. Where the year has gone by, I don't know, but it's nice to have completed 26 episodes. Thank you, viewers, for watching our show. We really appreciate the time that you give us and all the feedback that we get, all the questions that we get. So, very exciting, Lalit Ji.
Congratulations, Paresh Ji, first of all, and thank you very much, viewers, for watching us. It's been a year, like Paresh Ji said. We don't know how fast it went, so but here we are starting a second season, and this is our first episode today. And Paresh Ji will be educating us about a lot of personal financial decisions that as individuals or businesses have to make. So the very first question that I have, Paresh Ji, which is a very common question that people, individuals and families have. And one of the biggest purchases that a family makes is a home. And he should begin planning for the purchase for the first home. And there are a lot of hows and whens and what is the right time, what is the location. So educate us a little bit, at least financially, what should they look into?
First of all, thank you, Lalit Ji. And you know, it's always very exciting when we get into this process with any family in the process of buying their first home. I mean, you know, owning your home, moving from a rental home to your own home is always brings about big smiles on everybody's face. It's fun to do this type of planning. The first step usually is to identify well where they're going to purchase the home, and then after that, what the value of the home that they want to purchase. Now, usually when we ask these questions at the time of planning, couples or families do not know the answer to that question. They're usually, you know, they're usually thinking that, you know, maybe this area, maybe that area. So sometimes there is a pre-step to the first step, which is the first step, as I said, is identifying what is the dollar amount or the range in which they want to purchase the home. But the pre-step to that is what are their priorities, like school district or location close to their place of work or availability of, say, public transport, etc. So first we help them to go through that. That's a pre-step. And once we've gone through that, then we come to know, okay, this is the place where they want to buy the home. And then we then they can look at what value that home is going to be, because the approximate range of value is what will kind of take us to the next step.
But Paresh, that's a great beginning, but how does one know what they can afford versus what they want, which has always been a challenge as far as when I see it and within the families, people want bigger houses, not necessarily they can afford it. So that's a big question, and I personally want to make sure that my clients don't make that mistake. So give us some feedback into that.
Well, you're so right about this thing. You know, it's purchasing the home is often tends to become more of an emotional decision, and a lot of people do end up overextending themselves, and that can mean financial mess in the future. So what we start with is we use a tool which we call the living balance sheet. And in that tool, we identify a person's assets, liabilities. That is, assets is what they own, liabilities is what they owe, and the difference is what we call the net worth, or the amount of money that they have. And then there are two more components which we call the income and expenses, or the budget that they have. That means we want to see, from these we want to see two things. First of all, based on the assets and the liabilities, we are able to see how much money they can put down, how much money they can afford to put down, and even what money will be left after that, because the banks do want to see that when you take a mortgage, there is some money left even after putting down. And the second thing, based on the income and expense statement, we are able to see that what is their expenses which will stop once they move from renting to owners, like the rental expenses. And then after that, what is the amount of savings that they do? Combine that together, it will give us the dollar amount what they can afford to pay as mortgage. But then there's also, we can also do some additional extrapolation on top of this, because Lalitji, as you've correctly mentioned in your shows earlier about deductions, itemized deductions. So
Absolutely.
we have that real estate interest on the home that you purchase, and on mortgage
taxes,
and real estate taxes. Those are itemized deductions.
right?
So since they have to be paid from pre-tax dollars, now we are actually able to afford a little more than the rent because of the tax saving that take place. So we do try to tweak that and take that into account when we see what is the budget available for the mortgage. Then after that, what we find is sometimes client may or may not be able to put down all the down payment, but they do not want to buy the home immediately also. So what we can do is we can put a plan in place whereby they can use their savings to build up on their assets, which can then be used as a down payment maybe 18 months later or 24 months later. Sometimes we also realize during this process that even despite being able to save, the down payment may not be enough, or the budget is not enough to buy the home. Then we ask we have to talk to the family to reconsider their buying decision. And sometimes you can take a step decision. That means you first buy a smaller home, you move into it, live in that 5-7 years, build up the means to buy the new home or a bigger home, which is what the family may aspire for eventually. So this is some of the work that we need to do at this stage, Lalitji.
Yeah, but Pareshji, down payment is always a challenge when you look at the house that they want to purchase. So what kind of investment should they go in for? You know that the stock market is so volatile, so you cannot really, that's not a guaranteed way of getting money back for your down payment.
Right.
And the banks give you so little interest. So I don't know how long will that take to arrive at the dotted number for the down payment. So where should one invest so that they can get the desired down payment? Like you said, you can plan ahead 2, 3, 4 or 5 years ahead of time.
Yep.
To arrive at that down payment factor of buying a house.
Right. Lalitji, that's in today's low interest rate environment, we are actually facing a major challenge on that front. That means the FDIC insured interest rate that banks offer on monies either lying in checking, savings account, or even in CDs tends to be just so low that you really cannot save money and rely on that to even give you a reasonable growth. The solution to that sometimes may be to invest in some kind of bonds or bond funds that are available from corporates, which may give a little higher return. But even in that, we face something which is known as interest rate risk. Lalitji, I want to just take a little time to explain what is interest rate risk, because a lot of people do not understand interest rate risk, and at times they consider that bonds or bond funds are completely secure, and that may not be the case. So let us say, Lalitji, that I need a loan of $100, and you have $100 which you can loan me. Okay. Now that $100, let's say I agree that I'll pay you 5% rate of interest. So if I'm going to pay you 5% rate of interest, that means, and I need the money for 10 years time. So I'm going to pay you $5 every year at the end of the year. And then at the end of 10 years, I'll pay you 105 and I'll pay you your money back. We agree, we sign a note, you give me the money. Say 2 or 3 years go by, and now you need the $100. So you approach your friend and you ask him, you tell him that, Paresh, and let's say he also knows me. Say, take over this note. Paresh will pay you the interest and will also refund the money to you. Do you think he is going to accept that? He's going to give you the $100?
Paresh, that really depends. If he can earn more interest, then he might agree. But again, it depends on his circumstances.
That's right. Yeah. So if let's say in the market there is a lower rate of interest, then he's not going to agree. But if there's a higher rate of interest available, if there's a lower rate of interest, he's going to agree.
Right.
But if there is a higher rate of interest, then he's not going to agree.
Correct.
And so what happens is that if the interest rate he's getting is higher, he might tell you to discount the $100 and maybe give it to him for 95 or a lower amount. That is the interest rate risk when you invest in bond. So directly investing in bonds which give you a higher rate may not be a solution. There is another instrument which we call floating rate bonds, which the interest goes up or interest goes down along with the changes in the interest rate market. That may be a solution, but I must warn viewers that those products also have their own risks and everything should be checked out by the viewers properly. So what we are finding is that two things happen. When you start saving this money on a regular basis, in order to be able to build your savings so that you can put down the money for the down payment, then there are two things happening. One is, of course, you're building and you're going to get savings, and we put it in the right kind of instrument, whether it's bond fund or floating rate bonds, or whether we put it in some other instrument. But what also happens is that the savings also causes an effect that every month, since you're putting away that money, when eventually you'll move from rent to mortgage, you will not feel the pressure. So that becomes another very important component of this whole planning process. That is, if you started saving from the beginning and putting aside money which you don't see and which is going away into that account, then after 2-3 years, when you actually get into the mortgage situation and the expenses maybe even go up, then you're not suddenly faced with pressure, which a lot of people are when they buy their first home. So,
absolutely. But the purchase of home is often considered to be a great asset for future. What do you feel about home as an asset for a long term, 10 years, 15, 20 years?
Lalit, I'd really like to qualify my answer to this one, because I think the purchase of the home is more an emotional decision than a financial decision. Having said that, it has been observed that like most asset classes, the value of the home does go up over a period of time. Not only that, since you're paying down interest as well as principal, you're building your equity. That means when you pay down the principal, your equity goes up inside the home. So yes, in that way you're creating equity, and also the appreciation on the home will add to the total value that you have. Just to throw a few numbers here, if you are putting down, say, on a $100,000 home, you're putting down $20,000, then let's say it grows to $140,000, then your $20,000 became $40,000 plus maybe the equity you built up. But then in 2006, 2007, people who purchased homes, their values just now barely have come up. So it's not necessary. It's not necessarily the best financial decision. Yes, it could work in the long run. I think you got to look at it from the emotional and the family perspective a little more than from the financial perspective as the purchase of the home.
So even though historically, if you look at last 50, 60 years, the real estate has done very well, except for last 10 or so years, we saw a major recession. That does happen every 40, 30, 40, 50, 70 years. So that's when, if you are caught in between, then yes, the real estate value really plummeted and people were affected. Yes. But otherwise, for most part, I've seen it's a good decision.
It's a very good decision. You should get into buying a home quickly, even if it means a smaller home to start with.
Right. Pareshji, this is a very interesting topic. I have a lot of questions, but as usual, we are running out of time this time. So I will have few more questions next time or the next time we take up this topic. So thank you again. Thank you for giving us valuable information. This is a good encouragement for people to look into owning our own home, which is known as American Dream. So good luck, viewers, and if you have any questions, please feel free to call Paresh ji at his either through his email or his phone number. Thank you again.